morning, everyone, and welcome back to our weekly webinar series. Over to Anil sir.
Thank you, Ankit. Welcome to our 147th episode of AAA Weekly Webinar Series. We are completely coinciding with the budget speech today, but yes, we got the feedback that there is no need to change the timing for our webinar. Although we also would like to see the uh, presentation of budget by Honorable Finance Minister, but we have a different audience and they are interested more in insolvency. And today's subject is otherwise, see, like we had prepared for part 2 of cross-border insolvency. But Ankit informed me that from 1st of February 2025, the revised international valuation standards are getting effective. So therefore, it is important for us as an insolvency professional, as registered valuers, as a company law experts, and also as an income tax practitioner to understand what exactly are the changes in the international valuation standards. Before even we go ahead, we would like to see what exactly the Indian laws are and where this international valuation standards would be used. Starting with the insolvency law, we have Regulation 2035 of the CIRP regulations, which says that the valuation would be done as per internationally accepted valuation standards. Now, internationally accepted valuation standards are not exactly international valuation standards. The international valuation standards is one kind of international valuation standards which are issued by International Valuation Standard Council, which is based out of London. Although in India, this is most accepted valuation standards. So we can say that in Indian context, internationally accepted valuation standards are international valuation standards released by International Valuation Standard Council based out of London with respect to the valuation of assets. Now, there are different valuation standards which are available in the world. I will give a little brief about that. However, I would also say one thing, that the Regulation 35 of the IBBI regulations for liquidation processes says that the valuation would be conducted in accordance with companies, registered valuers and valuation rules 2017. And when we see what is actually mentioned in the registered valuers and valuation rules, then we would see that the rule 17 also says the valuation standard to be followed by registered valuers would be internationally accepted valuation standards. Internationally accepted valuation standards. So when this team, our research team, started studying what exactly are the international acceptable valuation standards, then we came to know that the internationally accepted valuation standards, like international valuation standards, are one of the internationally accepted financial standards. And then the second best, even in India, we also recognize International Financial Reporting Standards. Although this is not valuation standard, but it is international financial reporting standards. And then there is also one standard which is known in the world is generally accepted valuation standards, that is also based out of the practices commonly adopted in the world, and those are also by tradition and by practices. Then it is also considered as uniform standards of professional appraisal practice. So that is also a kind of there is an appraisal foundation in United States. So that is also used in USA, and that is also used for real estate businesses and intangible assets. So USPAP, Uniform Standards of Professional Appraisal Practice, that is also kind of focuses on the ethical and performance standards for appraisers. Then there are European Valuation Standards, EVS. This is also issued by the European Group of Valuers Association. The European Group of Valuers Association, and these valuation standards are also popular in Europe. And then in India, we also have Indian Valuation Standards, that is IND-AS. And IND-AS 113 is also the Indian Valuation Standards. So when we say, because this IND-AS is also corresponds to IFRS 13. In India, it is IND-AS 113, and internationally, it is IFRS 13, which is the International Financial Reporting Standards. Now, when we have seen, like, these are the internationally accepted valuation standards, and in India, we can also say that in the company's registered valuers and valuation rules 2017, it is again the word written is the internationally accepted valuation standards. And in India, we have this one, international valuation standards, and then the second is that the this IFRS. So when we say that the valuers are supposed to do valuation, so in case required, in case some financial assets are also required to be valued, so it should be valued based on international valuation standards, which Ankit is going to discuss, coupled with IND-AS 113, which is corresponding to IFRS 13, which is corresponding to IFRS 13. See, before I hand it over to Ankit for clause by clause analysis of the changes, I would also like to kind of say that the valuation is also a challenging profession, and it is the use of this profession, the opportunities for this profession. In fact, it is, uh, in fact, it is changing, and it is increasing day by day. See, when we see Section 247 of the Companies Act, that says that the valuation by registered valuers. This particular section of the Companies Act 2013 says that the valuation required under the Act must be conducted by a registered valuer. But it doesn't say IBBI registered valuer. So, Ankit, does this registered valuer, which is mentioned in Section 247 of the Companies Act, does this mean that it has to be IBBI registered valuer now, as of today?
Yeah, so registered valuer is of course I will be a registered valuer because the entire registered valuer, the whatever 5,000 valuers which are registered with IBBI today, they are all registered under 247, read with companies registered valuers and valuation rules 2017. So this is the combination that kind of drives the entire system. These are the regulations that control the registration and the conduct of valuers in under this framework. The only other framework which is available for registered valuers is what is there in the Wealth Tax Act. That is still relevant, not primarily because there's because of course the Wealth Tax Act values are recognized under the Income Tax Act for the purpose of some limited purposes, including valuation as on 1/4/2001 for properties,
Hmm.
and of course they're recognized under SURFACI still because SURFACI rules are yet to be changed. They still talk about a wealth tax registered valuer to be empaneled by the bank. That's why registered valuers under wealth tax also remain important. But yes, that might change. SEBI has taken a step forward in December. SEBI has to remove any clash of interest, withdrawn the powers of merchant bankers to give any valuation report. So now merchant bankers cannot give any valuation report. They cannot take up any valuation assignment. So the valuation assignments can be taken up under FEMA by chartered accountants, by cost accountants, And so this is the legal framework right now. Also, Rule 8 of companies registered and valuation rules clearly says that till the time India does not have its own valuation standards, the valuers will have to follow internationally accepted standards or the standard adopted by their RVO. And most of the RVOs in India have adopted IVS issued by IVSC. That is what has changed effective from 31st of January 2025. And the previous version that came in was effective from 31st January 2022. So this one has come in after 3 years.
Okay, good, Ankit. So I think like I'll just take another 2-3 minutes to make our audience understand like what are the opportunities under the valuation for registered valuers. See, when I looked into Section 230, and then the National Company Law Tribunal has powers to order a valuation of shares, valuation of assets, or even the liabilities during a scheme of compromise or arrangement. Even in Section 232, the valuation in mergers and amalgamations, the tribunal NCLT may require a valuation report for the purpose of mergers or even amalgamations. And Ankit, even the company's compromise arrangements and amalgamation rules 2016 and the Rule 18 requires that a valuation report to be submitted to the tribunal in case of mergers or amalgamations. And when we talk about the any kind of valuation is required when issuing shares, particularly at a premium or for non-cash consideration. Any issue of shares at a premium or for non-cash consideration will also require valuation of shares. Section 62 of the Companies Act deals with it, and it says valuation for preferential allotment of shares and such issue of shares on preferential basis must be valued by a registered valuer. Section 42 also talks about valuation for private placement of shares. So the shares issued under private placement must be valued by a registered valuer. And then we talk about the rules, companies share capital and debenture rules 2014, and rule 13 says the valuation report required for preferential allotment of shares, and the valuation report is required for issue of shares for cash and non-cash consideration. That is Rule 14. Then we talk about the Section 68, which talks about buyback of shares. So the company must determine the price of shares based on a valuation of report, and that's what is the rule. The company's share capital and debenture rules 2014 says, and rule 17 says the valuation report is required for buyback of shares also. And in the as we say, the valuation is also required for reduction of capital, but that of course in section 281 also evaluation is required. We have already seen even in companies, even in the insolvency law, whenever we try to determine undervalued transaction, then either the valuation will be required by the transactional auditor, or the valuation might even be required by the tribunal, by the adjudicating authority while adjudicating a undervalued transactions. That is also which is required. And when the anyway, there are a lot of other requirements of valuation, which is even the company's meeting of board and its power rules 2014. The valuation report may be required for even related party transactions, the rule 15 says. And then the valuation of sweat equity shares, where the section 54 issue of sweat equity shares also requires valuation. And the like then the ESOPs, the section 62, even for ESOPs, employee stock options, the valuation is required. And then we also can say the compromise and arrangement we've already seen, the mergers and demerger we've already seen, cross-border mergers and see again the same. And similarly, the corporate social responsibility section 135 may also require for a kind of contribution in kind. And then there are rules company's corporate social responsibility policy rules 2014, which also requires that in case there is any contribution in kind, then the valuation may be required. So this is all I wanted to highlight, that the valuation by registered valuer is very important, and therefore it is really important for all of us to know what all are the changes in the process, in the methodology, and Ankit will explain us clause by clause the changes made by this modification in the international valuation. Ankit, over to you.
Just put up the screen. Just give me a second.
So you are sharing screen, so it's happening.
Just setting it up. Right. So here we go. And just give me a second. Just reconfigure the screen. Right. So moving to the, of course, we're talking about the changes here. So broadly, what has happened in these two standards is that a major restructuring has been done with respect to the standards. So if you see this comparison table, you will be able to see that there was something that was called IVS framework, which they have converted into a full-fledged standard. They've also made a lot of changes where, of course, scope of work has been kept as it is, but this IVS, which was for investigations and compliance, that has been totally done away with, and it has been made part of the various asset-wise standards. Reporting, of course, has been changed to documentation and reporting, and then basis of value has been shifted. Valuation approaches and methods have also been restructured. They have also added new IVSs in the form of data and inputs and valuation models. So data and inputs is again a very, very important standard that they've created. Valuation models is also a very, very important standard that they've created, where they have what they've done is effectively they have made it clear that this is the process that should be adopted by the valuer to arrange the data, arrange the inputs, and source those data and inputs, and then also talked about the documentation of those inputs. Valuation models also has been expanded. Previously, valuation models was only a chapter in one of the IVSs. So now they have made a full-fledged IVS on valuation models. So what this effectively brings into picture is that the asset specific asset standards become more comprehensive with respect to what kind of investigations and compliances are required to be done by the valuer to take up the valuation. And also what happens here is that the data and inputs and valuation models become more relevant and more important for all the valuers, including land and building and plant and machinery valuers. Otherwise, previously we were mostly looking at valuation models as a term that is used for financial modeling and SFA valuers, but now it has been extended to others as well. The asset standards broadly remain the same. The names look the same. There is complete revamp that has been done to IVS 500, where financial instruments is what is talked about. Also, plant and equipment has been renamed to also include infrastructure now. But other than that, mostly these standards have been revamped internally. There is no major change in the terminology or overall structure of these standards. Now, key changes in the foreword or in the introduction talk about deletion of something called principles of valuation standard setting. So they say they might have thought of that valuation standard setting is something that is, a background work. Why should it be part of the valuation standards themselves? So they have moved it. They have comprehensively revamped the core principles of valuation, and they have changed that. They moved previous sections of IVS framework, IVS general standards, and IVS standard. All these have been, the structure has been overall changed. Effective date terminology has been changed. So this is how they have made these changes. Then a key change that has happened, which is important for insolvency and also for all of us professionals as valuers also, is how they have changed the definition of liquidation value. So this slide will tell you how the definition itself has changed. Earlier, the definition of liquidation value included the word piecemeal basis. And this used to create a lot of confusion also, because when we used to talk about realizable value under insolvency, under the liquidation regulations, the realizable value could be based on assets which were sold together in parcels, on a slum sale, a slum sale basis. Company as a going concern was also possible. So now they have in fact removed the word piecemeal basis, and they have simply added now that the liquidation value. So basically, this is when the gross amount that would be realized when an asset or group of assets are sold from liquidation sale, with the seller being compelled to sell as on a specific date. So the only basis now, the major differentiation that they have now kept here is that the liquidation, in case of liquidation, the seller will want to sell the assets within a shorter period of time, within a shorter date, and other aspects where you talk about as is where is basis sale, how much additional investment can a seller would want to place in the assets before he liquidates the asset. All those things then become of course important, but then the primary definition does not now include the word piecemeal basis. So this we used to carve out a departure when we used to do a valuation report, that okay, IVS says piecemeal basis, but because IBC allows for other modes of sale, we would not always assume piecemeal basis unless and until the case scenario was like that. So we have then made that this is the change that we could see here, a major change in the definitions itself. Other things that they have added now, so this is the glossary that they have in the IVS. So they have added the concept of or accepted the concept of automated valuation models. So we see more and more AVMs coming into picture as AI is advancing, as data analytics is increasing. AVMs have started taking shape. AVMs in India are based on data that is, of course, captured by valuers and valuation reports. We see some AVMs operating on a standalone basis with some NBFCs, with some banks based on their internal data, internal valuation report data. Internationally, AVMs are doing a good job because the data with respect to property transactions and sale prices is public. And therefore, AVMs there are able to do a lot better job with respect to land and building and plant and machinery assets, because AVMs are, of course, data hungry. They cannot work without data. So can't valuers, but valuers can then use their estimation and use their market surveys to come out with the value. In India, we don't have all the data with respect to transactions available freely. So sometimes we have to use the traditional approach of finding the market or doing a market survey where we call people who are having exposure to that market and ask them for prices. We are then sometimes mimicking ourselves as buyers or sellers of a property. So all those things have to be done, which are otherwise avoidable. ESG is something that they have introduced. Data they have quantified, and they have started then using data as a definition across all standards. And they have introduced both quantitative and qualitative information that is available to the valuer and defined that as data. Intangible assets is something that they have defined. Previously, this was covered in the framework that they have deleted, but now they have introduced that as part of the definitions itself. Similarly, liability assets, they have asset valuation, they have changed. Observable data, they have modified. They have introduced the concepts of professional judgment and professional skepticism. Now, when we are talking about audits, one of the first things that we used to learn was professional skepticism. This was taught to us that whenever a valuer does any evaluation work, or whenever an auditor does any audit work, as chartered accountants, we used to be taught that you also always have to be doubtful about what is happening, and rely only on data or only on documents that you're able to observe, and not blindly trust what somebody is saying. So you have always have to be doubtful, and आपको आपको शकी किस्म का इंसान रहना चाहिए. That is skepticism. So the valuers have also now been asked to have their own professional judgment, and also talk about the professional skepticism, that they have to be have to have a questioning mind, and a critical assessment has to be done. They can't just say, oh, the client has given us projected data, and that is what we need to work on. They have to be doubtful. They have to have a questioning mind on that. They have then increased the liability of the valuer when the valuers use a service organization and or a specialist. So service organization and specialist is something that a lot of valuers were relying on, and then they used to kind of waive their liability or responsibility on that. So service organization and so specialist liabilities are concepts that they have introduced. Valuation model, of course, I've talked about. They have also added the concepts of review and revamped the valuation review part. And valuation risk is also something that they've started talking about in the valuation standards. Now, these are the definitions that they have changed extensively. So assets has been given a very wide definition now. They used to have three words which were should, may, and shall. So what they've done is they have removed the concept of may now. They say that nothing may would mean that the valuer may do this process. So the standards used to have some compliances on that. So now they've completely removed that, made it simple that, okay, he should, unless the valuer can demonstrate that alternative actions were sufficient for the purpose of taking care of that requirement under the standard. Then, of course, significant valuation, they have defined all that. They've changed these definitions, valuation method, weight, and all that has been changed. Other changes, so they have removed some references which are available as which were captured in the standards, like fair market value, fair value, because I believe they got the feedback that if they're covering these words in the definitions, then they are also then confusing people as to what fair value and what fair market value is. They've completely removed them. As I said, they have removed the concept of may. They have removed the word purpose and replaced it completely with intended use. Intended use is the word that they now say or kind of say, so there is no confusion on that. Then, of course, valuation reviewer, weighing, all these things have changed. And they've, of course, made minor changes, cosmetic changes in some of these words. Now, when we come to IVS 100, which is the valuation framework, the key changes here are, of course, making this renaming the same. Professional skepticism, I have already talked about. They've added a completely new section on valuation process quality control and use of a specialist or service organization. So, as I said, quality control standard has been introduced the way it is already there in our audit standards. They have introduced it in valuation standards now, and of course they have moved some items here and there. So they say that the valuer must have quality controls or process quality controls. The extent of control should be determined having regard to the intended use. Assess the judgments made during the valuation. So controls have to be there. Controls have to be documented, and they should document it in such a manner that they should allow another valuer to understand the effectiveness of the controls. Then they talk about how then they talk about how just a second. Then they talk about how there should be periodic assessment of the controls to ensure that their integrity and completeness are appropriate as of the valuation date. So this is how they have kind of added this part. Then use of specialist or service organization. So they have made a complete chapter out of this, making it very clear that the prior to using the specialist or service organization, the valuer must assess and document the knowledge, skill, and ability of the specialist or service organization, and he has to look at all these factors. Then the specialist or service organization, the valuer must obtain an understanding of the process and findings to establish a reasonable basis to rely on their work. So the responsibility to do this vetting now lies with the valuer. It used to be lying with the valuer, but it was less comprehensive. Now they have added a full-fledged section on this, so that kind of makes it much more, complete. Scope of work extensively revised by them. So they of course say that there must be a scope of work must be agreed before the report is closed. Scope of work may change, and scope of work, they have also added, should not be overly restrictive. And if it is overly restrictive and not giving true picture of the valuation as per the IVS, then the valuation report will not be IVS compliant. So, what do they want you to kind of add in the scope of work? So, this is important for all professionals, including clients who are consuming the reports and also valuers, because scope of work is something that is a document that both kind of see, and scope of work is something that is important to be kind of having all these clauses when we talk about an IVS compliant scope of work or IVS compliant report. So which assets or liabilities are being valued needs to be identified. Client needs to be identified. Intended use, intended user, the valuer, valuation currency, valuation date, basis of value, nature and extent of value's work and limitations thereon, nature and sources of information upon which the value relies, special assumptions, specialist, environments, ESG factors, what is to be done with them, type of report, restrictions on use, distribution, publication of the report, IVS compliance, and then finally they also say that these should be agreed in writing before the report starts. So they have made a lot of clarifications in this entire section. So every professional should review their scope of work and make sure that it is compliant with the new IVS. And then, of course, you have basis of value and valuation approaches. So they have comprehensively restructured the entire standard, which is the basis of value. And they what they have done is they have moved a lot of sections to appendices, and they have renumbered several sections, making it a more readable document. And then there is a lot of change in the language here and there. Similarly, valuation approaches, comprehensive restructuring of the entire section, including several numbers. So cosmetic changes in the language here as well. And differences in ESG considerations have now been added to the required adjustment to arrive at value. So wherever there is an ESG consideration, one will have to talk about it, valuer, and that has been introduced here. Data and input. So they have this is a newly carved out IVS, talks about the use of specialist or service organization, characteristics of relevant data, input selection, data and input documentation, and then also talk about ESG considerations. So they've completely built this standard from, of course, they've taken some data, some prior sections from other parts of the IVS, but
I
now this is a
I think
completely different IVS.
Ankit, we have got a feedback that the screen which is visible is
Mhm.
actually not really adjusted. I think what is happening is that you see, you are also appearing and I'm also appearing on the other two sides. Like, you see, basically you are appearing twice, but the screen that way has reduced to a very small part. So we
I
actually
will I will try this now. Is this better?
now this is better, but then this is something which is it is not, so the screen is much better, but it is I think this is much better. We can
Okay.
continue this. Yeah.
I can try and see if there is anything else I can do. Just give me a second.
The other thing which is possible is that the anyone who is speaking should appear on the right side, but slightly bigger.
Yeah, let me see in case I can do something about it. But I think because I am sharing, I will just see in case I can do something about it.
But as far as the screen visibility is concerned, this is the best.
All right, I think we can move forward on this. Then we
And
can.
video, maybe it's not okay, but then that in case we can try for the time being. The face of the speaker, it is smaller, but it is on the right side. It's okay.
See if I can change it. I think I can now. Um, I think it should change now.
But it is actually visible in the manner that on the right side, uh, you and me, and then the screen.
Anyways,
I think
so
let's continue.
so then we have this valuation models, that is again a newly added section. So again talks about like characteristics and appropriate valuation models, valuation model selection and use, valuation model documentation. So again talks about extensively about which valuation model has been adopted or what is the feature of the valuation model. So it wants the valuer to, the IVS now wants the valuer to talk about the valuation model in a much more precise manner as compared to earlier. Then other standards, of course, documentation and reporting, the entire IVS has been revised there. Business and business interests, we see minor revisions only. Intangible assets, they have added something called cost savings method and income approach. So that's a new method that has been added. Non-financial liabilities, again, they have added contingencies like litigation reserves and contingencies, and indemnifications and guarantees have been added in the list of liabilities, and they have made other minor changes. In plant and machinery, what I see in IVS 300 and IVS 400, which are major standards which are used for plant by P&M valuers and land and building valuers respectively, what they have done is they have, of course, made major changes in valuation approach, and of course they have made very major changes in how liquidation value is computed, and how the income approach, sorry, cost approach and market approach are computed. Section 70s and 80 are like completely revamped. We can look at them separately as well. Trending method is something that they've recognized in IBS now. Trending method is typically used by many valuers in India, where the historical values are indexed in wherever they are not able to get comparable data for similar assets in the market. So trending method has now been recognized in the standards. Then the extent of investigation, special assumptions. Then they have added data inputs, valuation models, documentation. They've changed all that. Then of course they have just a second, just a second. Yeah. So then real property interest, they have of course revamped this also. Financial instruments, as I said, they have completely revamped this section. So a lot of changes. I think what I can say is that I can try and talk about some specific ones, and I can
I think there
show.
are a couple of relevant questions that I can see, and I think we see the very first question that has actually come from Mr. Purani uh, Kumukund. Any specific change in plant and machinery valuation from 1st February?
I think he means any specific change in the standard since
Yes.
1st February. So what I can do is I can quickly run through the changes. Now, this is the red line version of the IVS. It should be available to everyone. If not, then we can also share it, but it's something that is available from the IVS website also. So I will show you the relevant parts. So one, see, they have introduced, they have asked one to kind of look at the historical capital expenditure. Then if you look at how others changes, the scope of work majorly, the blue text is what they have simply moved, the red text is what they have added. So in case you look at this whole part, which is the liquidation value, it has been completely revamped. Whatever was written earlier, they have completely revamped it. So it's important for the plant and machinery valuers to understand that the in situ and ex situ basis has been clearly written, and the characteristics of that. So because when we were practically doing the evaluation, we were always talking about in situ and ex situ factors, and now they're clearly recognized in the standard itself. And the relevant factors that have been, or costs or other values that come into consideration, if the assets are removed and if the assets are kept where they are, we, like, from our experience, we can say make a big difference in the value that is computed. Then in market approach also, if you see that they really want you to look at actual sale of identical assets, actual sales of similar assets, and they have kind of redefined this also. And then they have also talked about that depending upon the asset being valued, market evidence may be considered in a variety of ways, that is piecemeal, production line. So because values can change, in case you look at a single machine and an individual asset, that can have a very different value as compared to the complete plant. So, depending on the actual facts of the matter. So actual sales, they say much. So this way they have kind of, you know, given a lot of certainty as to how the market factors will be taken into consideration. Then they have talked about how similar assets will be, adjustments have to be made for all these factors. Some of these were already there in the other standards, but now they have comprehensively talked about it. Then they talked about direct adjustment, indirect adjustment. They've talked about evidence in an active and transparent market should always be preferred to an inactive and opaque market. Then income approach also, if you see, they have made a lot of changes here, and all this is, kind of freshly carved out sections that now values will have to follow to make sure that their reports are IVS compliant. So this is the major change here. Then trending method, as I said, the trending method is where you kind of estimate the asset's reproduction cost by applying an index or a trend factor to the asset's historical cost. So this was not recognized earlier, and we were seeing many people do this. So now they have actually talked about this and kind of placed controls over it, because otherwise, people were simply using an index factor without using any other professional judgment as to what those values are coming out to be. Similarly, they have now kind of talked about data and inputs, and they say that how will the hierarchy of data use happen, what kind of inputs and what kind of disclosures are required to be made in the report with respect to data and inputs that are used uh, by the valuers. In case you look at 100.05, this says the selection, source, and use of the inputs must be explained, justified, and documented. So, therefore, that becomes important. Similarly, even valuation models, they say you have to adopt a suitable valuation model, or you have to talk about the characteristics of the valuation model. So these are like then allocation of value and so on. So these are the major changes in P&M valuation. Similar changes in the land and building valuation asset IVS also.
So another question which is coming from, I think that is coming from Shana Karkar, like, what are the controls? What are the controls?
So
Example.
I think
I think the word control is used somewhere, and he's asking.
I think when if I want to talk about control, then the kind of controls per se is not a very specific word that they talk about, but I think he's talking about the quality controls. So quality controls that they want, sir, I can talk about it. Quality controls is something that they just a second. So quality control, when it talks about quality control, when we see, otherwise also valuation process quality control. Just give me a second. So in case you're able to see my screen, when you talk about quality controls, so valuation process quality controls, they say that there must be some controls. This should be without bias and compliance. Then controls should be documented. So when we talk about any controls, even if we talk about, let's say, internal controls in an organization, we talk about controls which are there in a valuation report. You talk about how an organization will have, some system of an internal check, and how the report quality is being examined. So in a typical system, one can say that the X person will make a report, and there will be a partner who will be reviewing that report. Uh, there is a checklist that is made based on an IVS checklist, which is, an organization's checklist, which the organization kind of makes sure is kind of worked on before the report is issued to the client. So these are controls that one would have, and these controls need to be, of course, talked about in the report now.
Also, I couldn't understand the question. The again, Shankarkar is asking. So, orderly liquidation is not liquidation value now,
No,
since
orderly
it is
orderly
not
liquidation is
a
very
particular
much.
asset.
No, so orderly
Yeah.
liquidation is still so liquidation value is what has been changed. Orderly liquidation has not been changed. Orderly liquidation and forced sale are two premises under which liquidation value can be determined. So orderly liquidation typically says that the time period for which the asset should be typically exposed to is still available. But yes, the seller is in urgency to sell, and that is what discounts or kind of gives lesser value to the seller, or the seller is not able to make any improvements in the asset, he wants to sell it as on an as is where is basis is what is the quality of an orderly liquidation. So it is still there. It has not been changed, and particular date is not changed. Valuation date will always be there. Valuation date is still there. Then I
So,
think there is another question
Purani,
which says
Purani
what is.
Kutum, yes, yeah, you can see. Yes, yes,
So
please.
there is a question that is fair value changed to something. So rather, what they've done is they have, of course, previously also IVS used to identify non-IVS stand, non-IVS basis, and fair value was never a IVS base, but they used to recognize three valuation bases which are used by other organizations. One was fair value as defined by OECD. The second was fair value defined by IFRS, and then of course there was fair market value as defined under US IRS regulations. So these were three that they used to talk about, but now they have removed them and they have said that okay, whatever is the requirement of these specific basis can be picked up from the respective statutes. So even earlier, when we were using IBS, the 2022 version, we were talking about fair value under IBC as defined in IBC. And now also we'll continue doing that. Fair value as defined in IBC is market value, but market value as on the CRP commencement date, and market value only of the assets and not of the liabilities. So that's how the fair value defined under IBC is different from the market value which is defined under IBS. So those changes we make when we make the reports.
So, I believe the uh, like there's one question: is the use of valuation software allowed in the new standards? Any kind of
Valuation
valuation
software,
software?
in case you mean by valuation software, you mean automated valuation models. So yes, they are allowed, but then these AVMs are, of course, see, I will just talk about this quickly. So I'll just share it with you. So it simply says that no model without the value applying professional judgment, like an AVM, can produce an IVS compliant valuation. So it says that even if you're using an AVM, an automated valuation model, you have to talk about how you used your professional judgment on the results or on the data that the AVM is picking up. You cannot really say that, oh, this was an AVM generated report, therefore I never applied my professional judgment. That's how it is.
I think we can continue with our presentation regarding the changes.
Yes.
Like, see again, it's read that some question which is again not a procedural one. So, what about a valuer who is working independently? What will be the quality control method for him?
As I said, some examples are that he can say that, oh, this is a checklist that he follows before issuing the final report. So the checklist can still be made by him even if he doesn't have any person in his office to kind of have a control setup where one person is kind of reviewing the other's work. Alternatively, one can talk about how he kind of can talk about the checklist can kind of he can say that the checklist is comprehensive in the sense that the checklist is not only talking about the IVS and the regulations or the rules, but the checklist also talks about observations that he has made from peer review exercises that have been made public by the RBOs. So this way, I believe quality control methods can be described.
I think we can continue our presentation, or because see, there are no raised hand also. So I think we should finish the important part. We have still 8 minutes.
Yes, I'm coming to now the IVS 400, and I want to quickly talk about what are the changes that have happened there. Just give me a second. So I'm coming to IVS 400 now. I'm talking about what has been the kind of important changes in IVS 400. I think we can quickly run through the major changes so that we are kind of and we can read it significantly later. So these are all sections that have been moved from the previous investigations and compliance. These standards were there, so they are not new ones. But then, of course, they like if you read this, then the requirement. So in addition to the requirements to state the extent of investigation and nature of source of information to be relied on IBS 101 scope of work, the following matters should also be considered. So extent of any inspection, and it says responsibility for information on the site area, site characteristics, building characteristics, or building floor areas. Responsible for information on the area, characteristics, and productivity generating attributes of land. Responsibility of confirming the specification and condition of the building. The responsibility of confirming the specification conditions of the plantation, vegetation, forest, or crop, if applicable. Then quality of reserves and extent of remedial measures post extraction. So the scope of work now kind of is very clear that you have to talk about who is responsible for identification of these factors. So there can be two possibilities here. The client says, oh, I don't have any information here. So in that case, the valuer will become responsible, or they have to decide between themselves as to how they will distribute this responsibility between themselves. Similarly, then they have to talk about special assumptions. So that the economic activity will continue into perpetuity. So that's something which is always, they have to talk about it. The planning permission will be granted for the proposed change of use. So these are not specifically written items, although earlier also this was a comprehensive section in the sense one could have already always used another factor, but now a valuer who is doing the report has to look into these details because they're also part of the standards. If they don't, then there can be a difficulty later. So they have introduced hectare or acre here. They have introduced price per unit in terms of megawatt here. Then they kind of talk about the age and specification of improvements here. So this way, there are these minor changes in the entire report. The major ones are again then talk about data and inputs. So it talks about how the value must maximize the use of relevant and observable data. Then he talks about how the direct comparable evidence, indirect comparable evidence, general market data, and other sources have to be kind of looked into in this hierarchy when it comes to doing evaluation. Then so the hierarchy of comparable evidence has being made more important. Of course, valuation models we have already talked about. I think I can also then talk about documentation and reporting. So basically, all it should include the valuation report should include all appropriate references to all matters addressed in the agreed scope of work, and basically the report should also comment on the effect of the reported value of any associated tangible or intangible asset. So it should not be a standalone report. It has to talk about how the value of this asset will change in case there is any change in the associated tangible or intangible assets. So this is also something which is important that they have clarified now. And then they talk about valuation review and so on. So this is the standard on that. I will also, I think, use 5 minutes to talk about the valuation model and how that standard has been revamped. So this is the IVS 105 now, which is valuation models. Talks about how the AVM automated valuation model can produce an IVS compliant report with professional judgment. And they talk about how valuation model is a tool and how it should be tested to ensure accuracy, and how a service or a specialist organization can be used. Characteristics of an appropriate valuation model, then they have written. Then they have talked about how one can select and use a valuation model, and also talked about the limitations. Then they talk about suitable valuation model should have documentation that includes the following information, that is support for selection or creation of the valuation model, description of the inputs, significant inputs, limitations, quality control procedures and results. So this is how they have also talked about the valuers, valuer applying professional judgment when he is using a professional model, a valuation model. So changes in technology in the valuation space have now kind of permitted more automated valuation models and advanced models. So it becomes an important to for the standards to recognize them and also place the responsibility for their use on the valuers themselves. That becomes then important. I think there are a few more questions that I can take up. Um, then data in ESG to be considered in valuation. That's a question from Mr. Spandian. I will just talk about that. Just give me a second.
Again, our own partner Veer Singh ji asking whether you would be circulating the short form of the changes made to all valuation colleagues.
We will certainly do that. So data and inputs appendix in IVS 104 talks about the various basically factors which affect. So they talk about examples of environmental factors they've listed down. They talked about the social factors that kind of can impact a valuation report or impact the values. Then they talk about governance factors. So this is how they've kind of listed down all the ESG factors that can be considered when one is doing the valuation report. So this is now part of an appendix to 104. That is where you will find it.
So I think, uh, like I can only say that the shorter version of these changes, and I would rather recommend that we should actually say that how much it is affecting on the liquidation value, because I could see there are a lot of changes in uh, assessment of liquidation value of a corporate debtor. We should write an article and circulate to all our colleagues how the revised uh, IVS, International Valuation Standards, are impacting the liquidation values of the corporate debtors. That is we should write the article, and that will be circulated.
Great. I think that's a great idea. We can certainly do that. And now I would say that there can be multiple liquidation values. I think we have always talked about that in IBC. But yes, even in IVS now, liquidation values can be multiple liquidation values depending on whether you are selling the assets in which way. And of course, anyone who is doing the valuation will want to have the maximization of value even in case of liquidation value, but depending on the circumstances, liquidation value can also change.
Even Mr. N.S. Ranjan is asking any specific duty of insolvency professional which has changed or modified because of these
I think
changes.
the duty remains so that I think rather than me calling it duty, I think it's more of a more of a collateral responsibility. In case an IP is relying on a valuation report which is faulty or which is not kind of properly documenting the standards, there is possibility of unnecessary litigation. There is a possibility of I would say the process getting derailed. So yes, I know that we cannot expect everyone to be master of everything. So I can't expect insolvency professionals to start reading IVS. But I think a little discussion with the valuers can, give them that when they're choosing a valuer, they can simply ask the valuers that how compliant or what kind of understanding do you have on the new standards? So, and whether they can even ask for sample reports, ask them in case those sample reports incorporate the new standards, that can save some trouble for them.
Great. I think this is really good. And there are some amendments in the IBBI regulations. I think there are about three very, very brief regulation modifications have been done. So that also we would be attending. And we are coming up with the part two of cross-border insolvency. We would be analyzing the uh, proposed part Z to IBC clause by clause. And we will also spare some time, maybe 10 minutes, for giving these new changes in the regulations.
Yeah,
Thank you very
and
much.
to add
Yes,
to that, any changes in the new union budget which affect insolvency would also be something that we will have to
yes,
talk
yes,
about.
yes.
Yes.
So please go ahead, listen to the budget speech of Honorable Finance Minister of India. Thank you very much. This is our way of learning.
Thank you, everyone. Thank you.